I need to say that if you look at the commodities complex around the world right now, the only other commodity that is stupidly underpriced is water. And it's stupidly underpriced because the price of water is controlled politically. So it's not unlikely to stay stupidly underpriced. Water, I mean, there's a couple of things that you need to know about investing in water. First of all, you have to invest in water in dry places. I live in the Pacific Northwest, where the challenge is to make the stuff go away. So you need to have regional scarcities of water, and you also need to own water in places that can afford to pay for it. There are some very dry places like Eritrea or Djibouti where you can own all you want, but you can't sell it. So that doesn't work. The biggest complexity with regards to water, though, is that the allocation isn't a function of utility, but rather political power. Water flows unnaturally uphill to votes rather than naturally downhill to money. If you look at markets like California, 85% of the water that's consumed in California is consumed for agricultural purposes. Agriculture in California delivers 2.5% of the state's GDP. My farmer friends are not going to like to hear this, but water in California is worth more money for flushing toilets and brushing teeth than it is for growing rice in the desert. And you would have less of a problem of water allocation in California if you allowed various constituencies to bid against each other for the water. That isn't happening.
So how do you go long? Do you go long that through going long food?
What I did, I mean, 30 years ago, 35 years ago, I simply bought water rights, and it worked out for me very, very, very well. One of my favorite puns now is that one of the problems with water as an investment class is it's illiquid. You can easily sell water rights, but you can't buy them anymore. The big farmers and some of the big financial interests have bought them up. You can buy some of you can buy, as an example, entitled farmland. That is to say, farmland that has water rights attached to it. Farmland is becoming expensive too. You'll recall that the first interview that you and I did 3 years ago, I was sort of pounding the table on farmland in the upper Midwest. Sadly, I was too right, which is to say it's almost unbuyable now at prices that generate an economic return. But there are two stocks that people could look at, both very liquid, so be careful buying them. One would be JG Boswell, which is the largest corporate farmer in the state of California. People regard it as a cotton grower, which it is, the largest cotton grower in the United States, but more importantly, it's the largest private water rights owner in the state of California by a country mile. The second would be Limoneira, which is a company that farms particularly citrus and avocados. Its real attraction is that it owns the 2,200 acres fee simple land in Santa Paula, California, which is slowly being converted from things like flower fields to single family residential. But in addition to that, it's a very large water rights owner in Ventura County in California. And I think that the stock is priced basically to reflect their sales of lemons and avocados, which I don't think reflects what the future sales value of their real estate portfolio or their water portfolio will reflect. Please don't everybody run out and try and buy these two stocks. Use limit orders. They're both illiquid. Boswell in particular, JG Boswell isn't listed. It never went public. It trades over the counter. It's been an over the counter stock for 110 years. You almost have to make an appointment to make a trade. So buy this stock with a very long perspective, and please use discretion the way you trade it.
Yeah. What is the magic number, talking about the production cost for things like coal and copper? Because long term, I really like coal because it's probably the most hated energy source. And it reminds me, the other day I was listening to Jim Rogers' book, Hot Commodities. I don't know if you remember that one from like 2003, 4. One of his favorite commodities at the time was lead. And I really got a kick out of that because I remember during that time frame how lead was just public enemy number one. I mean, it was getting in the bloodstream of kids, and people were ripping it off the walls because it was in the paint and everything. And, he gave his bullish argument on it, and it sounded very, very similar to what you hear today in coal. And then I remember after listening to that book, I went and looked at a chart of what lead did from like 2005 to 2008, and it literally went parabolic. But anyway, what are your thoughts on those two?
You can afford to hate lead if you hate electricity. If you aren't willing to have batteries. We talk about all these wonderful battery metals. The lead acid battery, irrespective of the inroads lithium is making, is the battery on a global basis that matters. The coal price, people don't realize this, but the best performing commodity in the last 2 years has been coal. Biden doesn't like it. Greta doesn't like it. None of the big thinkers like it, but everybody who wants the light to go on likes it. Everybody wants to flip a switch and have the light go on. It's highly amusing to me that the Germans in their wisdom shut down their nuclear fleet, and they've replaced the base load that they used to generate with non-carbon generating nuclear with lignite, this brown, sulfurous, dirty, ash-heavy coal. It is absolutely hilarious to me that Ms. Merkel's green legacy has been to double the utilization of coal in the world's allegedly greenest economy.
Right.
The coal price right now is very stout. While two things, I guess, burden the coal industry. One, capital is becoming less and less available. More of the big thinking banks have decided for various reasons that they won't provide capital to the coal business. I would note that ICICI Bank of India and China Commercial Bank are not among those banks. So capital is still available to the coal industry. But the coal industry is becoming uninsurable too, given the fact that among my business interests is a company that provides environmental insurance to the coal industry. I'm delighted with the fact that my big competitors, who could stop me anytime they wanted to, have decided to exit an industry. That's important to me. But the coal price is very strong. What isn't strong has been, the coal equities. I draw your attention, and this is not a stock recommendation, but the diversified multinational miner Glencore was able to acquire, I believe, a 50% interest in one of their coal operations from a partner. This coal operation is a world scale mine, 30-year mine life, best quartile worldwide in terms of cost of production, best quartile worldwide in terms of return on capital employed. They were able to buy the interest in this coal project that a partner had for a 1.5-year payout. Wow. In a 30-year reserve. That's the opportunity that you see in the coal business. But by my traditional metric, which is to say cost of production being higher than the price that you can sell the product for, that isn't true. The world is really constrained in terms of coal capacity now. Nobody wants to admit that they're selling it. But basically India and China and other pariahs like Germany will take all you can sell them.
So what would you, so the price is run. It's definitely not a quote unquote cheap based on its historic price adjusted for inflation. It is not cheap compared to the cost of production. So if you were long-term bullish, what would you look for? Would you just look for the price to come down to a specific level adjusted for inflation? Would you wait for it to get under that production cost, or would there be another?
I think it depends on who you are as an investor. If you are an investor like most who are underinvested in natural resources, I think you also need to look at the incentive price, which is different than the producing price. So as an example, right now in the copper business, we are selling copper for $3.80, $3.90 a pound. And that's plenty for existing production. You begin to shut down existing production at some number like $2 or $2.50. That belies the fact that we haven't opened very many new copper mines in the last 30 years. and all of the existing production, it's kind of my age, it's long of tooth. And the incentive price for new copper production is probably closer to $4.50.
Wow.
So in a commodity like copper, where you're facing a circumstance where supply is falling off a cliff and demand is increasing rapidly, you can be a little bit more generous with regards to strategic parameters, which is to say, and I think you can do this with uranium too, given the fact that the supply deficits are going to be so egregious, I think that you can look at the incentive price to bring on new production. And while it's not as conservative a substitute as total production cost for existing production, I think it's valid.
How do you determine the incentive price or incentive cost?
What I do is I pay attention to the industry-wide forecast from groups like Mineral Economics Group, BHP, or some of the industry groups. In the energy business, I sort of grit my teeth and listen to the economic forecast from the International Energy Agency, which ironically is very anti-energy, but they do a fairly broad-based economic review of various energy industries on a global basis.